So, as usual, please always check that the recording is on so that we don't leave our communication or conversation in the basket. All right. So today we are going to be dissecting the cost of preference share. We are done with discussing cost of equity. However, for the benefits of those of you that are just joining the class for the first time, okay, the financial management class for the first time, I'm going to do a recap on what we did last time. This is going to be our lecture day 2 for financial management on my own scope, right? So last week, we started cost of capital. We started with the introduction to cost of capital, after which we moved to discussing the importance of cost of capital. Then, of course, thereafter, we discussed the categories of cost of capital. We then begin to discuss or to explain the concept of cost of equity, right? For the introduction, we said that cost of capital is the compensation required by the providers of capital, including ordinary shareholders, preference shareholders, as well as the debt holders from their investment in a company. Usually, the compensation that the providers of funds are requesting or are requiring for the business simply is a kind of return on their investments. Like, for example, the ordinary shareholders are going to earn dividend income from the business. Preference shareholders will also earn fixed dividend from the company, while the debt holders will earn a return on their investment in form of interest, right? And we said that cost of capital is usually determined by the market forces of demand and supply, depending on the perceived risk associated with a company. That is, the higher the risk, the higher the underlying risk, the higher the cost of capital that the company is going to pay. We then move on to discussing the importance of cost of capital. Basically, we said that the significance of cost of capital include, number one, project evaluation. We explained that to mean that in determining the financial viability of a project, cost of capital will be required to discount the future expected cash flows to the present value equivalent and investment appraisal techniques, such as the net present value, internal rate of return, profitability index, benefit cost ratio, or in a more advanced, adjusted present value or modified internal rate of return. Of course, those techniques are not within your syllabus. All right, when you get to SFM, you'll be talking about adjusted present value or a modified internal rate of return, project duration, and all of that. Okay, so we also said that it will be almost impossible to ascertain financial viability of a project without the use of a cost of capital. The second one is determining capital mix, that is debt equity proportion. Cost of capital will enable a firm to ascertain the proportion of equity and debt to be carried in the capital structure in order to minimize the overall cost of capital. All right. Those are the key to significance or importance of cost of capital. We then move on to discussing the categories of cost of capital. And we said that cost of capital can be grouped into 3. Anytime you are asked to calculate cost of capital, it has to be one of the 3. The first one is traditional weighted average cost of capital. Number 2, project-specific cost of capital. Then number 3, weighted average cost of capital of the combined activities. These are the 3 forms of cost of capital. Anytime you are asked to calculate WACC, it has to be one of the 3. We then started with the first one, which is traditional weighted average cost of capital. And we said that traditional weighted average cost of capital is computed when information about capital structure, that is, ordinary share capital, preference share capital, and debt capital, including their underlying costs, such as dividends and interest, are given in a question. So when you are given the statement of financial position and also income statement, from the statement of financial position, you can see ordinary share capital, you can see preference share capital and debt capital. It means that you are supposed to calculate weighted average cost of capital using the traditional method. All right. We then say to calculate weighted average cost of capital, there are 4 procedures you are supposed to carry out. The first step is to estimate cost of equity. Step 2, you calculate cost of preference share. Step 3, you compute cost of debt. And step 4, you determine weighted average cost of capital. Those are the 4 procedures that you are supposed to carry out anytime you want to estimate WACC. We then started with the first one, right? Which is cost of equity. So we said cost of equity is the minimum required rate of return expected by the ordinary shareholders from their investments in a firm. And it is also known as opportunity cost of capital. We also discussed the methods of calculating cost of equity. We said cost of equity can be computed using either dividend valuation model, number 2, capital asset pricing model, number 3, or Miller and Modigliani formula. We started with dividend valuation model. We said that dividend valuation model should be used to calculate cost of equity when information about dividend and share price are given, and it is computed as the ratio of dividend to ex-div share price, depending on whether or not there's growth in dividend payments. So I provided you with 2 different formulas that you can use to estimate cost of equity using dividend valuation model. We then move on to discuss the concept of cum-div and ex-div share price. We said that in the calculation of cost of equity, only ex-div share price should be used. So what is ex-div share price? What is cum-div share price? We said cum-div share price is the share price that includes dividend. Cum-div share price is the share price that includes dividend. If you are told in a question that dividend is about to be paid, or dividend will be paid, or dividend is outstanding, it means that the share price given to you is cum-div share price. So if examiner likes you, if examiner likes your face, all right, or your examiner is in love with you, they can expressly state it in the question that share price, or the share price is 1 naira 50 kobo, cum-div. So that is clearly stated in the question. But where examiner just mentioned that the share price is 1 naira 50 kobo, the current dividend of 20 kobo is about to be paid, or will be paid, or is outstanding, it means that the share price given to you is cum-div share price. So you don't use cum-div share price to calculate cost of equity. It has to be ex-div share price. So for this purpose, When CumDiv share price is given to you, you have to convert it to XDiv share price. So what is XDiv share price? XDiv share price is the share price that excludes dividend. So if you are told in a question that the dividend, you are given a share price, for example, company XYZ PLC has 1 million ordinary share of 1 naira each, currently quoted at 2 naira. The current dividend was paid. The current dividend was recently paid. So because dividend has been paid, it means that the share price of 2 naira given to you is already XDiv. So do no adjustment. That is the share price that you should use. However, if CumDiv share price is given to you, you have to convert it to XDiv share price before you can proceed to calculate your cost of equity. So how do you convert CumDiv share price to XDiv share price? Very simple. Just deduct. You deduct the current dividend from the CumDiv share price. Whatever you have thereafter will give you the XDiv share price. Finally, what we discussed last week, we also discussed how to estimate growth rates. Basically, we said there are two methods of calculating growth rates. We talked about historical pattern of dividend payments. We also talked about Gordon growth model. The first one, which is historical pattern of dividend payments, we said it is also known as averaging method, and that the historical pattern of dividend payment is used to calculate growth rates. When past information or when information about dividend payment are given in a question, when you are given the amount of dividend paid in a question, it means that you are supposed to use the historical pattern of dividend payment. Let's say, for example, you have you are given 4 years in a question, and you are given the amount of dividend paid for all the years. It means that, and you want to calculate the increase, the percentage increase in dividend over the years, then in that case, you are supposed to use the historical pattern of dividend payment. And I provided you with 2 different formulas that you can use depending on the information available in the question. All right. Then the last one, where we stopped last week, was how to estimate growth rate using the Gordon growth model. And we said that Gordon growth model should be used to calculate growth rates when information about earnings, that is profit after tax, and capital employed are given in a question. All right. And of course, I demonstrated the formula that you can use to calculate the your growth rates using the Gordon growth model. First thing first, you need to calculate the return on investment or return on capital employed. I gave you the formula to use. Then proceed to calculating the retention rates, which I also gave you 3 different formulas that you can use to calculate the retention. And that is where we stopped in our last class. Please, I beg each and every one of you, don't make noise in my class. We are going to quarrel. Be careful. Watch out for me. I can hit you hard. You don't make noise in my class. Please, always mute yourself. If you want to speak, if you want to ask me a question, just raise your hand. I will allow you to talk. Don't distract me, please. All right, then. So today we are going to be discussing how to calculate cost of preference share. All right, we are going to be discussing how to calculate cost of preference share. So you have the material at your end, so you can open it in case, because I may not follow, I may have 1 or 2 things I need to chip in on the material you are seeing on the screen, different from the material you have on the screen. Yes, Biola, talk to me.
You skip the capping, so and which is cost of capital equity too. So I don't know, are we doing it now or later? Capping.
No, I did not skip it. I think I mentioned it
Okay.
last week too. capping
Okay.
is a topic on its own, right?
Oh,
So we are
okay.
going to dissect. You know, when I was doing the introduction, I mentioned it. So when I was explaining my scope, right? So capping is a topic on its own. We are going to spend between let's say 2 periods for us to be able to complete capital asset pricing model. So that's why I did not mention it here. All right.
Okay,
Okay.
sir.
Yeah. So let's talk about how to calculate cost of preference share. First thing first, what do you understand by cost of preference share, right? What are the types of preference share? How do you estimate redeemable and irredeemable preference share? So quickly, let's discuss that. The cost of preference share represent the compensation required by the providers of preference share capital from their investments in a firm. The preference shareholders are entitled to fixed dividend from the business, and they will be paid before the ordinary shareholders. I repeat, the cost of preference share represent the compensation required by the providers of preference share capital from their investments in a firm. The preference shareholders are entitled to fixed dividend from the business, and they will be paid before the ordinary shareholders. You know, in the statement of profit or loss accounts, right? The top line item is revenue. From the revenue, you deduct cost of sales, right? Then you have your gross profits. From your gross profits, you deduct operating cost or operating expenses. Then you have your operating profits. That is profit before interest and tax. From the profit before interest and tax, the first category of investors that you are going to pay is the debt holders. So you first of all deduct interest expense from your profit before interest and tax. Then you are going to have profit before tax. You charge your tax, you have your profit after tax. Yeah. Immediately after the profit after tax, you must first of all pay preference dividend. Whatever you have thereafter, after you have deducted preference dividend, is what is known as profit available for distribution to the owners of the business. So that's why I'm saying that the preference shareholders are entitled to fixed dividend. Their dividend will not increase. It's the same amount as agreed ab initio with the company. All right. However, they must be paid the preference dividend before the ordinary dividend will be paid. All right. Generally, preference share can be cumulative or non-cumulative, participating or non-participating, redeemable or irredeemable. So, of all of this, only the redeemable and irredeemable are relevant to our discussion. Other ones are purely theoretical. But for the purpose of your information, for example, when you talk about cumulative preference share, what that simply means is that in any year a company is unable to pay preference dividends, the dividend can be carried forward until the company is able to pay it. Let's say, for example, if in the first year a company makes loss, of course, you cannot pay dividend from the loss. All right. When a company makes loss, because you are unable to pay as a result of that, then the preference dividend you are supposed to pay in that first year, you are going to carry forward to the second year. If in the second year the company also makes loss, then the dividend you are supposed to pay in the first year will be added to the dividend in the second year. So you continue to carry it forward until the company is able to generate sufficient profit that will accommodate the outstanding dividend. All right. So you are accumulating it, you are adding it over and over until the company becomes profitable to be able to offset the outstanding dividend. So that is what is known as cumulative preference share. It has to be in the agreement from the beginning, the nature of the preference share. So the second one is non-cumulative preference share, which is opposite. Year a company is on the outstanding preference dividend shareholder we forfeit it. We forfeit cumulative and then the non-cumulative. Let me see, one of your races and the first person. Yes, talk to me, Sandra. Sandra, you raise hand. Let me go to Lovett. Lovett, you raise hand too. Talk to me.
Okay, good evening, sir. So my question is,
Yeah,
for the cumulative preference share. So I want to understand, is it not from the profits that the company made in a year that they are going to pay the preference share from? So if a company made a loss, how are they going to be accumulating loss for the preference shares holder? Is it not from the profits that we are
I don't know
paying
whether
that they
it's
are paying?
my, hold on, I don't know whether it's my network. We are breaking again. I don't know if it's, go ahead.
You also
Lovett.
break. Okay, okay, sir. So, Mike, I was asking that for the cumulative preference share, I was asking that is it not from the profit that the company made during a particular year that the preference share will be paid for from? If a company made loss, that's supposed to be like the preference shareholders, they will not have anything during that
I heard
period.
you,
So,
hold on, Lovett.
okay.
I heard that you mentioned the cumulative from something, so that I couldn't get you clearly. I don't know.
Sorry, that could be network. So, can you hear me now, sir?
Go ahead, let me see. Go ahead.
Okay, you say that for the cumulative preference share. So I was asking
Yes,
that for cumulative preference share, is it not the profit that the company made during a particular year that the preference shareholders will be paid from? So if a company
yes.
is making loss or if the company made a loss during a particular year, where are they going to get the money to pay them? If they made loss, which means it's not supposed to be like the preference shareholder, they will not have anything during that year.
Yes, if I get you clearly, shareholders are paid, the preference dividend are paid from profit, and that's the same thing we are saying here. There is no way you'll be able to only pay preference dividend. Profit after tax is. So what we are now saying is that if a company make a loss, there is no way you'll be able to pay preference dividend. So in that case, you have to carry it for sufficient profit to pay the outstanding dividend. That's what we mean, right? I don't know. Love it.
Sir, you keep
Yes,
on
sir.
you're breaking. Your voice is breaking, sir.
Because like I mentioned, I was struggling to hear love it. It has to be my network. I mean, is it better now?
It's better
Yes,
now,
sir.
sir.
Hello?
I
Yes,
could
it's
hear
better
you.
now.
Yes, sir.
What I'm saying is that according to what I heard from you saying that preference dividend will be paid from profit. That's the truth.
Yes.
Ordinarily, so what I'm now saying is that in this case, we are saying that the company make a loss, be able to pay dividend from loss. That will be double jeopardy, right? So the company make loss, you will not be able to pay preference dividend. So you have to carry it forward until the company is able to generate sufficient profit that will be able to cover the. That's why it is called cumulative. You'll be adding it. So if a company make profit, certainly you have to pay the preference dividend. But because the company make a loss, so you will not be able to the implication of the cumulative. Non-cumulative simply means that if a company make a loss in a particular year, you will not be able to pay that preference dividend. And also, the preference dividend cannot be carried forward. Let's say, for example, in the first year, a company make a loss, right? You are unable to pay the dividend. In the second year, the company now make profits. So the preference dividend you are supposed to pay in the first year, you cannot carry it to the second year, right? So in any year a company make a loss, the outstanding preference dividend will be forfeited. All right. So that's just the difference between the two. Okay. I believe my network is stable now. So love it. Hope that is clear to you now.
Yes, yes, sir.
Okay then. Sandra, you also raised hand the other time. What's your question?
Yes, sir. I said, what if the company never made a profit? What will then
Never
happen
made.
to
Never. That never is too strong. Let me put it that way. Companies are in business to make profit. The primary purpose of any business organization, of every profit-making organization, is to make profit to be able to enhance the shareholders' equity value. So if management of a company is making loss, is a serial loser, right? Of course, that means there is no way they'll be able to maximize the wealth of the owners, and they are to be in business if they continue to make profit for several years. So it's just that's that particular year where a company is going to make a loss. So it's not going to be forever. All right. What we are saying is just for few years, particularly when a company is just starting a business, there's likelihood that the business may not be profitable at the start of the business because your operating expenses or your overhead maybe so much such for you to be able to cover the little inflows, the little revenue the business is going to generate. All right. So there is no, it's just for just a short time. All right. The losses will just be for a short time, not forever. Okay. Yes. Constant.
Yes, sir.
Constant.
Yes, sir. I guess the answer you just gave will probably cover up for what I wanted to ask, because for this non-cumulative, first of
Yeah.
all, I wanted to ask if it is practicable, if it is in practice. Secondly, does it not give room for manipulation or something? Like, the company might want to declare loss for 1 or 2 years because they don't want to pay preferred shareholders. They don't want to pay them their own dividend. So that was my question. That is the question I actually want to ask. If it will not give room for manipulation and hiding of things and all those things, just to put the account into loss so that they will not pay dividend out to preferred shareholders.
Yeah, it is possible, but again, the contribution in most cases, the contribution of the preference shareholders is not really that significant relative to other categories of investor like the ordinary shareholders and the likes. So for the company to now say because of the fact that they want to be unethical by declaring losses so that they won't be able to pay preference dividends, that will not arise. All right. So again, particularly if it's a public company, if it's a company that its share is publicly traded, all right. So the information is there in the market. Nothing is hidden. All right. So there is no way the company will be able to hide such a thing from the preference shareholders because it's a public company. All right. So there are third parties. Everybody, all eyes are usually on the public company. So it will be almost impossible for. Of course, management can carry out what we understand as somersaulting accounting or what we call a creative to achieve a particular target. But that notwithstanding, they can't be doing that because of preference shareholders. Yeah. So we are assuming that they are going to act fairly to all the investors, and at the same time, they are going to operate with integrity. So they can't be hiding intentionally making loss so that they won't be able to pay preference dividend. The preference dividend we are talking about is may not even up to 5% of the total profit of the organization. All right. Okay, then.
Sir. Thank you, sir.
Yeah. So let's talk about the main one, which is redeemable and irredeemable preference share. We are going to start with irredeemable preference share. What do you understand by irredeemable preference share? The irredeemable preference share is the one in which the company is expected to pay annual fixed dividend, but the principal will not be repaid. I repeat, irredeemable preference share is the one in which the company is expected to pay annual fixed dividend, but the principal will not be repaid. For example, if a company invests 1 million naira in another company, 1 million preference share in another company, with the hope of earning a return of 10% on their investment, right? So that 10% is what the preference shareholder is going to earn as dividend. So because it is irredeemable, it means that the company will only be paying annual fixed dividend, but the principal of 1 million naira contributed in the business will never be repaid. So the company, let's say for example, 10% of 1 million naira is 100,000. So it means that the company will be paying 100,000 naira to the preference shareholders for the foreseeable future to infinity. As long as the business is in operation, the company will continue to pay that fixed dividend of 100,000. But that capital contributed by the preference shareholder of 1 million naira, the company will never pay it back to the preference shareholders. That is what is called irredeemable preference share. That is, you cannot redeem. Investors cannot redeem the capital they have contributed. They can't get it back again. All right. So the cost of irredeemable preference share represents the ratio of fixed dividend to ex-div share price. I repeat, the cost of irredeemable preference share represents the ratio of fixed dividend to ex-div share price. The same thing we did under cost of equity in relation to cum div, ex-div also applies to cost of preference share, right? So it is believed that before you can calculate cost of preference share, the dividend must have been paid. The preference dividend must have been paid. So if preference dividend is still outstanding or is about to be paid or is yet to be paid, it means that the share price given to you is cum div share price. So you have to convert it to ex-div share price, the same way we did under cost of equity. So anytime you want to calculate, okay, anytime you want to calculate cost of a preference share, so all you need to do, let me try this one. KP, let me write it out in full, just as an addition. It's the same thing as the formula you have on the screen. Let me see. Insert. Okay. So anytime you want to calculate cost of irredeemable preference share, simply divide the fixed dividend. There's nothing like growth under preference share. The dividend is fixed, it's constant, it will not change. So divided by X dividend share price. X dividend share price. So this is the formula to calculate the cost of irredeemable preference share. This is the formula to calculate the cost of irredeemable preference share. Then multiply by 100%. 100 over 1. Okay? So multiply by 100%. So this is it. What I have here is what I've written like this. So it's the same thing. All right. So this is the formula for calculating cost of irredeemable preference share. Now, the next thing we are going to discuss is cost of redeemable preference share. What is redeemable preference share? How do you estimate cost of redeemable preference share? So let's discuss that. Please, like I said, anytime you have a question, always raise your hand. I will allow you to talk. Now, let's talk about redeemable preference share. The redeemable preference share is the one in which the company is expected to pay annual fixed dividend and the principal at the maturity dates. I repeat, redeemable preference share is the one in which the company is expected to pay annual fixed dividend and the principal at the maturity or redemption dates. Usually, preference share can be redeemed at par, at premium, or at a discount. The par value of preference share, the par value or nominal value of preference share is always quoted at 1 naira. Okay, I repeat, the par value, let me put it here for you. Let me put just as an addition. Okay. The par value of preference share is always quoted at 1 naira. Okay, it's always quoted at 1 naira. So if the preference share is redeemed at par, it means that at 1 naira. If it's at a premium, it means that it is higher than 1 naira. If it's at a discount, it will be less than 1 naira. So the par value of preference share is always quoted at 1 naira. Okay, so that's that. Now, how do you calculate cost of redeemable preference share? The cost of redeemable preference share is calculated as internal rate of return. I repeat, the cost of redeemable preference share is computed as internal rate of return. And it can be calculated by carrying out the formula, the procedures below. Step 1, you assume 2 discount rates that will produce 2 opposing NPV. You can ignore all of this. This one is too long, so just cut it into 2. All right. So there are basically 2 steps. If you like, you can carry out the entire 5. It's still the same thing, but you can actually do 2 steps. So step 1 is to assume 2 discount rates that will produce 2 opposing NPV. That is a positive and negative NPV. Then step 2, you calculate you calculate cost of redeemable preference share, that is internal rate of return, using the internal rate of return formula. That's all you need to do. First thing first, anytime you are asked to calculate cost of redeemable preference share, you should have it behind your mind that you are going to carry out 2 steps. Step 1 is to assume 2 discount rates. The first discount rate will give you are going to use the first discount rate to calculate NPV. If the first discount rate produces a positive NPV, you then assume another higher discount rate that will produce a negative NPV. That's step 1. Then step 2, you then proceed to calculate cost of redeemable preference share using internal rate of return formula. Therefore, anytime you want to compute cost of redeemable preference share, just go ahead and calculate internal rate of return. Just calculate internal rate of return. It's as simple as that. So to calculate internal rate of return, this is the formula. Cost of redeemable preference share will be calculated. I said KP, or we call it IRR. Okay. So A is the lower discount rate plus net present value of the lower discount rates over net present value of the lower discount rates plus net present value of the higher discount rates. All of that multiplied by higher discount rates minus lower discount rates. That will give you the internal rate of return, which is the same thing as cost of redeemable preference share. All right. So that is that as per preference share. It's not more than this. So what we discussed so far. Okay, Moses, talk to me.
Yes, sir. Please, sir, you mentioned that for us to calculate this preference using IRL method, we need to assume the present value. I don't know if I'm correct.
You assume 2 discount rates that will produce 2 opposing NPV.
Okay, now, sir.
Yes.
What of an exam condition? Maybe I assume 5 and 10, and someone else assumes. So, is there a way, like, when we are assuming, something is guiding that assumption? That is just, I don't know.
No. There's nothing like that. That's why one of the disadvantages of internal rate of return is that it's subjective, right? Examiner will not give to you the discount rate that you are going to use to calculate your internal, the cost of capital for you to be able to calculate your internal rate of return. No, you are the one that will assume it. Every student will have different, we are going to have different rates that they assume as their cost of capital for the purpose of calculating internal rate of return. Ideally, even at this level, examiner can still pardon you, or possibly whoever that will mark your script, or maybe examiner is not paying much attention to it. Anytime you want to compute internal rate of return, all right, there are ways because you have to be realistic, right? So when you are assuming your discount rate, let's say, for example, you assume 5%, and that 5% is positive. So you are supposed to increase it to 10% for you to be able to get a negative NPV, right? But if you assume 5%, you got positive NPV. You increase to 10%, you got positive NPV. That means you just be doing iteration, right? You just be doing trial and error. That's why it is IRR is also called trial and error method, you know. However, there are ways you can assume your discount rate, all right, when you are calculating your internal rate of return. For example, because you want to calculate NPV, the discount rate that you want to assume is what you want to use to calculate your NPV. Therefore, you have to check the size of your cash inflow relative to the size of your cash outflow for you to be able to say, okay, let me start with 10% or let me start with 20% or 15%. All right, in order to minimize the iteration. However, as we proceed, I will be demonstrating all of that for you, particularly under the capital budgeting. All right, I'll be demonstrating that for you. We'll see what I'm talking about. For now, it won't make much sense to you because we are not practicing it. All right. So, and then you also mentioned something. What if the other students, you are less concerned with what other student does in the exams, focus on your own. So, yeah. So, Evelyn, talk to me.
Okay, sir. Sir, can you hear me? Hello, sir.
Yes.
Okay,
Yes,
sir.
go ahead.
Sir, please, I needed you to clarify this formula for internal rate of return because I'm trying to see how I can master this because the one I know before, I can't really synchronize it too. There is a pattern I knew before, not this particular one, but I wanted to understand this. Which one is a positive NPV there? Which one is a negative? And which is the higher rate and which is the lower rate?
Okay. Now, usually, the lower rate is the one that will produce a positive NPV. So NPV of A simply means NPV of the lower rate. That lower rate will always produce a positive NPV. The higher rate, which is B, will produce the negative NPV. You know, some students are familiar with the fact that, okay, the formula I know before used to be NPV A plus NPV of A over NPV of A minus NPV of B. Some students are familiar with this, right? You know, in my own case, I use positive instead of negative, all right? So some students are familiar with this. They now get confused. Why is it positive? Ordinarily, like I mentioned, the lower discount rates will always give a positive NPV, and that's what you have as your numerator, right? So the higher discount rate will give you a negative NPV. So at the end of the day, this will then be, when you are doing your calculation, it will now be minus times minus. Do you get?
Yes.
So, so
Yes.
instead of you need to be doing minus times minus, I know minus times minus will give me positive, right? Right?
Yes.
So that's why at all time you are expected to just put positive instead of minus, just put positive there because you know that minus times minus will turn to positive. So it's a waste of time to be saying NPV of A minus NPV of B. Well, by the time you now put the figure, you now be doing minus times minus. You can't be doing that. It's a waste of time. All right?
Okay. Thank you, sir.
You are welcome. Go stand.
Okay, sir. Can we replace this? I'm just talking personally now. Can we replace this A with LR, that is lower rates, then B,
You can
HR,
use
higher rates?
anything. Go stand. You can use anything. Anything that is more confident, provided you define your variable. Like in my own case now, you can see I define my variable that A equal to lower rate. If you like, if you like, let me come here. Okay. Like if that is what you are familiar with, so be it. You can do lower rates, right? NPV of lower rates. You are still doing this. I've moved on to the next one because if I'm doing lower rates, I'm using only one letter. You are using two letters. So that means I'll be faster than you. So you can do it the way you like, provided you define your variables. All right. So there is no issue as per that. It's allowed. Okay. Then you then come here to say higher rates minus lower rates. So however you want to do it, you are good to go, provided you are doing the right thing. If this is what you are familiar with, so be it. Okay? Just stand.
Yes, sir. Thank you, sir.
All right then. You're welcome. So that is that as per uh, cost of preference share. I was trying to recap what we did. So like I said, there are preference share can be redeemable and then or irredeemable. The first one, which is irredeemable, is the one in which the company is expected to pay annual fixed dividend, but the principal will not be repaid. And it is the cost of irredeemable preference share is computed as the ratio of fixed dividend to XD share price. And I also mentioned that the same concept of cum div and XDiv under cost of equity also apply under cost of preference share. So because the preference dividend must have been paid before you compute your cost of preference share. So if the preference dividend has not been paid, it means that the share price is cum div share price. So you have to convert it to XDiv share price. We also discuss how to estimate cost of redeemable preference share. And we said that the redeemable preference share is the one in which the company is expected to pay annual fixed dividend and the principal at the maturity date. Okay? And it is computed as internal rate of return. The cost of redeemable preference share is computed as internal rate of return. Just use the IRR formula and you are good to go. Okay? And also, the nominal value or par value of preference share is always quoted at 1 naira per unit. It's always, per share. It's always quoted at 1 naira per share. Not only that, note, let me give you notes. All right. Preference share will be redeemable. Preference share will be redeemable if and only if and only if the maturity date or redemption date, if and only if the maturity date or redemption date is given. So if you are not given in a question when the preference share will be redeemed, then there is no way you'll be able to calculate cost of redeemable preference share. In that case, you are going to treat it as cost of irredeemable preference share. If the redemption date is not given, is not provided, it should be calculated as the cost of irredeemable preference share. All right, because oftentimes examiner may want to test students, preference share, may want to test students. The examiner may call it redeemable preference share, but redemption date will not be given to you, and student will then get confused. What am I supposed to do now? So anytime you are given a question and then you are told that examiner call it redeemable preference share or redeemable debt, whatever it is, proof is it can what make it to be redeemable is when you are given the redemption date or the maturity date. Let's say, for example, examiner can tell you that the company has preference share capital of 1 million naira, redeemable at par in 5 years' time. That 5 years' time is the redemption date. That is, that preference share of 1 million naira will be paid back. The company is going to repay the preference shareholders in 5 years' time. Okay, every year the company will only be paying annual fixed dividend. Then in the final year, which is the year 5, the company will then pay back. The company will pay back the preference dividend. That's why it is called redeemable. You are redeeming the principal amount. Okay. So what we are now saying now is that on the day of your exam, examiner may call it redeemable preference share, but in the question they may not give to you the redemption date. And we are now saying that if redemption date is not given to you, you have to treat it as cost of irredeemable preference share. Okay. It should be calculated, or it should be treated as the cost of irredeemable preference share. So that's that. So that's that as per cost of preference share. Let's move to cost of debt. Let's move to cost of debt. Okay. The cost of debt represents the compensation required by the providers of debt capital. Okay. It is a cost a company is expected to pay on the debt finance. You have borrowed loan, right? You borrowed loan from a company, right? And then, of course, that loan is not for free. You are supposed to pay interest on the loan. That interest is the cost of capital. It's the cost of capital that you have borrowed. All right. So that's why we said that cost of debt is the compensation required by the providers of debt capital. Okay. The debt holders are entitled to fixed interest from the business. All right. The company is expected to pay fixed interest to the debt holders. Usually, debt is a cheaper source of financing because of tax deductibility benefits. Let me see if it's here. Okay, let me just add it. Let me add it to your notes. In most cases, okay, let me see. Let me put it. Okay, it's here. In the live. Okay, let me put it down. It's not properly written. Debts is a cheaper source. It's a cheaper source of financing because of tax deductibility, because of tax deductibility. So what we are saying here is that because of tax, the company is expected to pay a lower cost relative to when there is no tax. All right. If in a question, for example, we are going to demonstrate this as we proceed. All right. So in a question, if you are given a tax rate, it means that the amount the cost that the company is going to pay will be lower relative to when there is no tax. So usually debts because of tax benefits, the cost that the company will pay on the debt will be lower relative to when there is no tax. All right. So generally, debts can be redeemable or irredeemable, callable or non-callable. Okay, callable or non-callable. Our focus is on the redeemable or irredeemable. All right. Let me just mention what callable and non-callable is. There's what we call That's what we call debt indenture. Okay? It's not part of your notes. Let me just put it somewhere. That's what we call debt indenture. Debt indenture is more like a contract agreement between the two parties, between the issuer of the debt and the debt holders, all right? Between the company and the investor. So this debt indenture is going to incorporate the dictates of the agreement, the dictates of the debt, all right? You know, when you talk about debt, we as a layman, we define debt as, maybe for example, a bond or debenture. They will say, okay, is an acknowledgement of debt. So you are acknowledging that you are owing somebody. Now, you are going to do bond valuation. I think it's part of your syllabus, if I'm correct, if I can remember. Now, you are going to do bond valuation and analysis. There are some features of debts. There are features that your bond should possess. One of it is there must be issuer. All right. Debt can be issued by different individual companies. All right. It can be issued by national or subnational. It can be issued by supranational organization. For example, most of the loans that Nigerian and every other nationals that they do seek, or they do get, are based on bonds. Okay. Now, these national governments, they are the issuer, because you are the one that wants to borrow loan, right? So you are the one, the bond you are going to issue. The bond is a form of, is a kind of certificate which you are going to give to the person that is borrowing you money. All right. Let's say, for example, Evelyn in this class is an investor, right? I am a company that is seeking loan. I can approach Evelyn PLC, for example, that, okay, I need a loan of 1 billion naira through bonds, for example, right? So I will be, as a company, I'm the one seeking the loan. Therefore, I am the issuer of the bond. I'm the one that will issue the bond certificate to Evelyn PLC. So Evelyn is the one that will keep the certificate, that will hold on to the certificate, as agreed in this debt indenture, as agreed ab initio. So the details of the investments, everything will be in the debt indenture. The nominal value, the coupon, the maturity, everything put together, it will be there, even on the face of the certificate. All right. So the person that is seeking the loan is the company. The company is the issuer of the bond. The person that is providing the loan is the bond holder or the debt holder. You are the one that is keeping that certificate. So you are holding it as an acknowledgement of debt, that, okay, oh, this company is owing me, oh, this is a certificate that the company issued to me. All right. So that's how it works. Now, when you now talk about callable debts, okay, when you talk about callable debt, a callable debt is a type of debt, is a kind of debt that allows the issuer to redeem the principal before the maturity date. Let's say, for example, the maturity date is in 5 years' time. All right. So when the interest rate changes and it favors the company, all right, and it favors the issuer, so the issuer can call it back, all right, so that they can readjust, they can refinance it at a consistent with the new rate. Let's say, for example, CBN, on a regular basis, they adjust their MPR, monetary policy rates, right? Let's say at the beginning, when this contract is being designed, the interest rate is 10%. So if CBN lower its interest rates, the rate at which banks will also borrow, will also lend, will reduce. So if the new interest rate changes and it favors the issuer of this bond or of this debt. So they can call back. They can call back the bonds so that they can refinance it at the current consistent with the current interest rate. So in this case, it will favor the issuer, that is the company that is borrowing the loan. All right. So when you talk about callable debt, it means that you can call back the debt before the maturity date. All right. So that will only happen only if the interest rate changes and it favors the issuer of the debt or of the bond. So of course, company cannot just call. It will be in the agreement from the beginning. That clause will be there. It will be there in the prospectus or in the debt indenture that they can call it back, because you have to, and you can't just call. There should be a call date. There should be a specific period in which you can call. You can't just get into an agreement in a year and then the second year because interest rate changes and you want to. So I have to protect myself as an investor. The agreement I'm going to sign to must be able to protect my own interest because I'm taking risk, and that is why callable debt is more risky relative to non-callable, and that's why the interest rate that the company is going to pay on the callable debt is higher relative to the non-callable. So for simplicity, callable debt simply means the company can call back the debt before the maturity date to reflect changes in interest, to reflect the new changes in the interest rates. So that's the meaning of callable debt. Then the non-callable debt simply means that irrespective of what happened in the future, the company cannot call back the debt. So irrespective of whether the interest rates is lower relative to what was signed ab initio, so you cannot change anything. Agreement is agreement. Okay, so that's just the difference between the two, even though it's not part of our, but I just have to mention that. So let's move on. Now, the cost of irredeemable debt. Okay, did I separate? Okay, the cost of irredeemable, like I mentioned, irredeemable debt is the one in which the company is expected to pay annual. Oh, I've not reached there. So let's start with irredeemable debt. So irredeemable debt is the one in which the company is expected to pay annual fixed interest, but the principal will not be repaid. Every year, the company will be paying annual fixed interest, but the principal contributed by the debt holders will never be repaid. And it is computed, the cost of irredeemable debt is computed.
There was no half it again.
Ahmed Akinwale, well done. Well done. So, the cost of irredeemable debt is computed as the ratio of fixed interest to X interest price, depending on whether or not there is tax. Okay, there are two different formulas that you can use to estimate cost of irredeemable debt. Let me break it down for you. Let me cancel this one and rewrite it for you. Okay. Number A, let's do it this way. Number A, where there is no tax, So if there is no tax, how do you estimate cost of irredeemable debt? So in this case, it will be fixed. It will be fixed interest. Let me remove this slant. Don't want. Okay, it should be fixed interest multiplied by, we said where there is no tax, so let's remove that. So fixed interest divided by X interest price. X interest price. All right. Multiply by 100%. So that will give you the This is how to calculate the cost of irredeemable debt where there is no tax, where there is no tax. Okay, so this is the formula to use. So at all time, your denominator must be X int price. So if you are given a cum int price, you must convert it to X int price. So let's talk about the second one, the second formula, which is where there is tax. Okay, where there is tax. So where there is tax, you are going to introduce 1 minus tax. All right, 1 minus tax rate. So that will give you then divided by X int price. So this is the formula to calculate cost of irredeemable debt where there is tax. Okay, all your answer must be multiplied with 100% because you are calculating a rate. So this is not needed again since I've removed that. Okay, so that's that. Then lastly, let's talk about cost of redeemable debt. First thing first, what is redeemable debt? A redeemable debt is the one in which the company is expected to pay. Okay, it's expected to pay annual fixed interest and the principal at the maturity date. A redeemable debt is the one in which the company is expected to pay annual fixed interest and the principal at the maturity date. Generally, debt can be redeemed at par, at a premium, or at a discount. Okay, debt can be redeemed at par, at premium, or at a discount. The par value, let me see if I can, let me see what I wrote here so that we know whether I should make a change. When debt is, okay, let me just add redeemable debts, redeemable, it is the one by which or in which the company is the issuer of the debt. The company is expected to pay annual fixed interest. Where are you? Where is that? Okay, interest. Let me highlight it. So it's the one in which the company is expected to pay annual fixed interest and the principal at the maturity or redemption dates. At the maturity dates, okay? Debts can be redeemed at par, premium, or discount. The par value, or it should be noted. Let me put it as a, let me put it, notes. Notes. That is always quoted at 100 naira per unit. So when we said that preference share is the nominal value or the par value of preference share is always quoted at 1 naira. So the same thing as quoted at 100 naira per unit, except if examiner wants you to use another bonds is usually quoted at 1,000 naira. Not told whether it is 100 naira or 1,000 naira. You are going to assume it is at par 100 naira. But if examiner wants you to use 1,000 naira, you are going to be given specifically. But in most cases, it will be 100 naira per unit of the debt. Okay? So debt is always quoted at 100 naira per unit, unless otherwise stated. Okay? So at times, if you are given 1,000 naira, if you are told it is at 1,000, so it's 1,000 you are going to use. So Biola, what's your question? Talk to me.
Good evening, sir. Once again, so I want to know, for example, if we are given the debt, debenture or the interest, sometimes the interest can come with maybe 6% and all that, and inside the question, we always have another interest paid. So I want to know this interest. Are we going to pay it on the par value, the discounted value, or the premium value? So I just want to know, sir. Thank you.
You want to know what? I didn't get you.
I'm saying
I
that.
hear.
Okay. So what I
Yeah,
what
talk
I'm
to me.
saying is that when they give us exam situation, so the venture
Yeah,
can come with a percentage, like maybe 6% or 7%. Inside the
yeah.
question, there will also be another interest to be paid. So my question is that interest, are we going to use that interest on the par value, the premium value, or the discounted value, or the nominal value? Or the nominal value is also the par value anyway. Yes.
Don't mix it. Don't mix it up.
Okay, so
Don't mix it up. If you are given interest, the coupon rate will always be given to you, right? So possibly maybe what you are talking about is the yield. At times you may be given coupon rate, you're also given yield. There's difference between the two. The yield, the coupon rate is the same thing as interest rates, which will come as part of the nominal value. Let's say, for example, you have a loan of 1 million naira at interest rate of 5%. That 5% is the coupon rate on the 1 million naira that the company is going to pay to the lender, right? So you cannot have two different interest rates for the same nominal value. You can't have two different interest, except if interest rate will change at a later date in the future. However, as we proceed, as we progress, when we start solving questions, then we'll be able to see the way examiner usually frame the questions, so that there will be nothing like mix up. All right. So,
all
but
right,
for
sir.
now,
Thank you,
it
sir.
will look very vague, right? So it will look very so. That's usually, as particularly when you are calculating, you want to examiner can ask you to determine bond value and all of that. So you may be given interest rates. So the yield can also be called yield to maturity or internal rate of return. So which may be different from the coupon rate given in the question. But in any case, like I said, as you progress, you are going to be seeing different scenario kind of questions that we are going to be, the way the examiner we always set it for you. All right. Okay. So like I said, debt is always quoted at 100 naira per unit, unless examiner says otherwise. All right. So if you are given 1,000 naira per unit, that's what you are going to use. But where examiner is silent, you have to use 100 naira. It is assumed it is quoted at 100 naira. So if debt is always quoted at 100 naira per unit, so that means this is the par value. If it's at a premium, then it will be more than 100 naira. Examiner can give you a premium of 5%. So 5% premium simply means 5% over 100 naira. That would be 105 naira. If it's at a discount of 10%, for example, 10% less 100 naira, that would be 90 naira. All right. So the par value, the benchmark is always at 100 naira. Okay. Then how do you calculate the cost of redeemable debt? The same way we explain the cost of redeemable preference share is the same thing you are going to do here. Anytime you want to compute cost of redeemable debt, simply go ahead, calculate internal rate of return. Okay. The cost of, let me put it down. Should I don't, this step is too much. Let me just shorten it to 2. All right. The cost of redeemable debt. The cost of redeemable debt is calculated as internal rate of return, and it involves the following steps, just like we did under cost of redeemable preference share. Step 1, okay, assume 2 discount rates that will produce a positive and negative NPV. All right, you are going to assume 2 discount rates that will produce 2 opposing NPV, a positive and negative. Then step 2, calculate internal rate of return using the formula below. That's all. It's not hard. Just know what you are doing. That's what I told you last week. I don't want you to be crammy. All right. I don't want you to be crammy, because when you cram a concept, and God help you, you see that on the day, you meet that on the day of your exam. Okay. Once you miss a step, all right. Once you miss a step, that means we can't go forward again. That's where you are going to stop. But what I want you to do is to master the concept. Okay. Understand the concept. And if you understand the concept, you'll be able to express yourself freely the way you want. Examiner is not saying you should write a voluminous solution. Demonstrate that you understand the requirement. That's all. So if you learn something new, don't stop there. Like the class we're having now, you have gained 1 or 2 things. Don't stop there. You can also go to your WhatsApp, for example. WhatsApp AI, explain cost of capital in details. You will see, we'll bring all those things that we are discussing. You can also add you are going to gain 1 or 2 things in addition to what we have discussed in class. You can use ChatGPT. During our own time, we don't have anything like AI. So no student should be failing any ICAN exam, because you have resources. You have plethora of resources for you to consult. If you are stuck somewhere, you don't have your notes or your textbook with you, you can Google it, you can search, go to AI. AI will provide you with any of those details. So that's what we are saying. So please, you'll be able to express yourself freely if and only if you take your study very seriously, right? Because the essence of researching, Emeka, why are you writing on my screen now? Stop it. The reason why you are expected to research is for you to be able to express yourself, to truly understand the concept. So you are going extra mile. On the day of your exam, that extra effort you are putting into answering the question is what will earn you the prize. So it is only when you understand, you have deep insights into the concepts, you'll be able to freely express yourself. Please, that is the approach that you should adopt. Don't limit your study to what you learn in the class alone. You have to go all out because you don't know where examiner is coming out to you. When you are in the class, the responsibility of your lecturers is to guide you, is to provide you the requisite guidance on how I can usually set their questions and then how to treat, how you are expected to treat or to solve the question. So the onus is on you to go all out to research more. All right, let's move on. Okay, so this is how to calculate cost of redeemable debt. So, and I said, just as a recap, before we move on to the next concept, and I said that debt, the cost of debt represents the compensation required by the providers of debt capital from their investments in a firm. And the debt holders are entitled to fixed interest from the business, and they must be paid. The debt holders must be paid before preference shareholders and then ordinary shareholders. We also mentioned that debt is a cheaper source of financing because of tax benefits, because of tax deductibility benefits. We mentioned that we say that debt can be redeemable or irredeemable, callable or non-callable. So we started our discussion with irredeemable debts. We said irredeemable debt is the one in which the company is expected to pay annual fixed interest, but the principal will not be repaid. The annual fixed interest will be paid to perpetuity, to infinity, until the business is no more, but the principal sum will never be repaid. And the cost of irredeemable debt is computed as the ratio of fixed interest to X interest price, depending on whether or not there is tax. So I show you two different formulas that you can use to calculate cost of irredeemable debt. Then the last one is cost of redeemable debt. We said is the one in which the company is expected to pay annual fixed interest and the principal at the maturity dates, and that debt can be redeemed at par, at premium, or at a discount. Okay, and we also mentioned that the par value or nominal value of a debt is always quoted at 100 naira per unit. Okay, so, and then the cost of redeemable debt is computed as internal rate of return. Cost of redeemable debt is computed as internal rate of return. Okay, so that's where we stopped. Okay. Let me just show you. Let me comment on that. Let me comment on that. You know, I mentioned cum div, ex div, share price. Sorry, so what I said cum div, cum int, x int price. So let me use here. Let me use here. Okay, concepts. Let me just give it to you. Concept of cum int interest price and x interest price. Okay, I'm gonna highlight it to make it different from what you have there before. Cum int price is the price that include interest. When the interest on the debt is outstanding or has not been paid, or will be paid, it means the market price of the debt. It means that the market price of the debt is cum int, which should not be used to calculate cost of debt. Okay, so that is as per that. On the flip side, or on the other hand, X interest price is the price that excludes interest, which is normally used to calculate cost of debt. Therefore, if cum int price is given, it should be converted to X int price as follows. Okay, you are my baby, so I have to bring it down to your level so that you understand better, because everything you are doing now, everything you are learning now under financial management, you will still learn it. You will learn it again under strategic financial management. So if you have deep understanding now, you are not going to struggle on financial management when you get to professional level. So X interest price is calculated as cum interest price minus interest minus the interest expense. So that will give you the X int price. So anytime you are calculating and then you are told in the question that interest has not been paid or the interest is outstanding, or even the examiner told you that is quoted at the debenture or the bond is quoted at 100 naira or 105 naira cum int, it means that you cannot use that value. You have to convert it to X int price first before you can calculate your cost of debt. Okay, so that's that. Finally, under cost of debts, let's talk about types of debts. Let's talk about types of debts. Okay, let me see. Types of debts. It's not here. Yeah, it's not here. So let me just show you. Let's discuss that. Yes, Unseen. Talk to me.
Yeah,
Unseen,
so
talk to
I
me.
want I want you to go back to the notes on this
Okay.
on the cum interest. It's
Okay.
like you wanted to say cum interest is, but there you put in.
Let me see. Cum interest price. Oh, is the price. Thank you.
Okay.
Yeah, thank you. So let's talk about types of debts. Examiner can ask you to explain the types of debts. So basically, there are two types of debts. Let me put it down for you. Basically, there are two types of debts. There are two types of debts, including number one, traded debts. Then number two, non-traded debts. So what do you understand by traded debts? Traded debts. These are fixed. These are fixed income securities. These are fixed income instruments. These are fixed income instruments that are tradable, or that can be bought or sold in an organized financial market. So any fixed income security financial market, any fixed income security that are traded in the market are what is known as traded debts. You can buy it, you can buy them, you can also sell them in the market. All right, so they are tradable. Examples include, what are the examples of traded debt? Let me ask any one of you. If you know it, raise your hand. What are the examples? Give me one example. If you know it, raise your hand. One example of traded. Yes, Biola.
Bonds.
You are correct. Clap for Biola. Pa, 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 pa. You are correct. Examples include bonds. Yes, another person should give me another example of traded debts. Yes. Yes, Ejem, talk to me.
I think debentures are a kind of
The
traded.
debenture. Thank you. You are good. Yeah, hey, these guys are ready for ICAN. Ejem, pam, 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 pam. Well done. Debenture. Yes, give me one more. Yes. One more. Let me check the message in case Treasury Brain. No. No. Treasury bill is not a form of debt. It's a form of investment, short-term marketable security. Okay. Okay, let me help you. We also have loan notes. Okay, loan notes. These are the examples of our traded debts. In most of our calculations, it will be on the traded debts. All right. So when you talk about debts, what we are referring to is either bonds, debenture, or loan notes. And like I mentioned earlier, most of the investments in the most loans are based on bonds. For example, most of the projects that Nigerian government are carrying out or they are developing or executing are based on bonds. Okay, bonds is similar to debenture.
That's
Who is that person? Olumide. Olumide, be careful. Anson, talk to me.
Yeah, so I just need some clarification.
Okay.
When you say loan notes, are you talking
Yep.
about like all these long-term loans that appears in the books of an entity, like maybe a company goes to BOI to collect loan for like 9 years or 7 years, as the case may be. Does that fall under traded debts?
No, any loan, if you, for example, if you go approach your bank and you borrow loan, you can't, your loan cannot be traded. You cannot sell your
Okay.
loan in the market. You can also not buy loan in the market. So that's not the kind of a loan we are talking about. All right. So before
Okay.
let's
Now,
start for, yeah, go ahead, answer.
all right, sir. So, okay, now, yeah, you say types of debts. You
Yeah.
mentioned traded debts, non-traded debts.
Yeah.
When we were starting this topic on cost of debt, you mentioned
Yeah.
redeemable, irredeemable debt,
Yeah.
callable and non-callable. Then what are
Those
those
are
ones? Are they not still
redeemable are just forms. It's just
oh,
nomenclature. It's just the way of. But when you
okay?
talk about real type, so you can categorize it in different ways. But when you talk about the real types of debts, they are traded and not traded. You cannot break it down. The other time we talk about redeemable or irredeemable, what we are talking about then is the same thing as bond, debenture, and all of that. But if the primary categorization would be traded and then non-traded. So if you now want to do the sub-categorization, you can be talking about redeemable or irredeemable. Okay? Answering.
I'm good. I'm okay, sir. Thank you, sir.
All right then. So the non-traded debts, these are fixed income securities that cannot be bought or sold, in an organized, just an opposite of the first one, in an organized financial market. They are securities, or they are a type of debts. Let me put it that way. They are a type of debts. Sorry. Of debts that are not tradable. Okay. Examples include, yes, you can give me one example of, I don't want Ijem and Biola to give me the to comment on this. I want others to talk on. Oh, See, Ezine,
Bank loan.
Ezine, you have given Expo. That is not good.
Bank
Monsurat,
loan.
all right, you are correct. Bank loan and overdraft.
Overdraft.
Yeah. Monsurat is also correct. So examples include bank loan and overdraft. Of course, can you carry your bank loan to the market to sell? You are given, for example, you are given an overdraft facility, and because you need money, right? Can you take it to the market and sell it? It's not possible, right? So unlike bonds, debenture, and the likes, if you invest in bonds, right, and then you need liquidity, that is, you need money. So when the need arises, you can easily dispose it off. Somebody is waiting for you in the market to buy from you, right? So those traded debts they are liquid, all right? You can easily trade, you can easily sell them, you can sell them, you can buy them. But your bond, so your bank loan or overdraft, it's not possible. All right. It's not possible. You cannot sell it. You cannot buy. So these are the overdrafts. So these are the examples. I mean, these are the types of traded debts. Okay. Let me see. The next thing we are going to discuss, this is all about, so far today, we have completed cost of preference share, how to estimate cost of preference share, and then how to estimate the cost of debt. Remember, we are still under traditional weighted average cost of capital. We said that there are 4 procedures of calculating traditional WACC. The first one is to calculate cost of equity, which we did last week. And then the second the second procedure is to calculate cost of preference share, which we have discussed earlier today. And then the third step is to calculate cost of debt, which we just finished. So the final step will then be to how to estimate weighted average cost of capital. However, before we move to discussing weighted average cost of capital, we need to discuss cost of convertible securities. Let's talk about cost of convertible securities. I want to see how I can simplify. I don't want too much notes. Let me just, let me reframe all whatever you have underneath here. Let me reframe it. Costs of convertible securities. So let's start from there. Okay. Yes. What do you mean by convertible? First of, before we begin to talk about cost of convertible security, you need to know what is convertible securities. Yes. Monsura, talk to me. Monsurat, you raised hand. Okay. I think let me read your question. What aspects of debts can we categorize commercial papers? Okay, do we want to say what aspect of debt can we categorize as commercial paper? Commercial paper is a source of let me call it short-term financing, just like you have treasury bill, right? It's a source of financing similar to, I mean, in the same category as a treasury bill, bankers' acceptance, and all of that. So they are source of financing generally. All right. So what accept can we? Okay, you write it. So yeah. Commercial, you have commercial paper, you have bankers acceptance, we also have a treasury bill, All right. So those are some of the sources of short-term marketable securities. All right. Short-term marketable securities. Okay. All right. So you are going to do source of financing. You are going to learn more as per that. Yeah. Okay. So we're about talking about cost of convertible securities. First thing first, before you begin to talk about cost of convertibles, you need to know what is convertible securities. What we are saying is that, you have in a company capital structure, you have ordinary share capital, preference share capital, and also debt capital. So the owners of the business, they are the shareholders. You also have some other categories of investors like preference shareholders and also debt holders. Now, if it's within the agreements that at a later future date, the preference shareholders or the debt holders, they can convert their interest into ordinary share capital. The preference shareholders can become ordinary shareholders. The debt holders can also become ordinary shareholders at a later future date. All right. So such security is what we call convertible security. Therefore, convertible securities, okay, let me put it down for you. Convertible security are fixed income securities. Fixed income security that can be converted to a known number of ordinary shares at a specified future date. Okay, convertible securities, let me remove bold name. Convertible securities are fixed income securities, including preference share, all right, preference share, bonds, debenture, etc. that can be converted to a known number of ordinary shares at a specified future date. The cost of convertible that's not correct. Convertible. The cost of convertible securities Emma Bino, that I'm slowing you down. The cost of convertible securities is calculated the same way as cost of redeemable preference share. You can call it preferred security or preference share. Preference share or redeemable debts or redeemable debt. Okay. By calculating internal rate of return. So anytime you are asked to calculate cost of convertible securities, simply go ahead and calculate internal rate of return. However, before that, you need to ascertain what kind of security do you have? Is it preference share? Is it bonds? Is it debenture? Is it loan note? All of these are forms of convertible securities. We call it fixed income security because the income that the investor is going to earn from the investment is fixed in nature. For example, the preference shareholders are entitled to fixed dividend, okay? The debt holders are also entitled to fixed interest. So the income they earn from the investment is fixed, and that's why it is called fixed income securities. Okay, fixed income securities include preference share, bonds, debenture, loan notes. All right. Now, if you want to calculate the cost of convertible security, so the same way you normally calculate your cost of redeemable debt or cost of redeemable preference share is the same thing you are going to do. However, what will make the only difference is just that instead of you to use redemption value, you are supposed to use conversion value. All right. So let me explain further. And this is where we are going to start. We're going to stop today. Or let me explain in details the cost of convertible security, and also I will still need to go back to our um, cost of debt and also cost of preference share to put an addition in terms of market value of preference share, how to calculate market value of preference share and market value of debt. Okay, so let me quickly finish this one before we move down to that side. Okay. I said the cost of convertible security is calculated the same way as cost of redeemable preference share or redeemable debt by simply calculating internal rate of return. Okay, by simply calculating internal rate of return. However, let me put a paragraph. However, the investors we only exercise the option or the rights. We only exercise the rights to convert only if it is profitable. That is, if the conversion price, if the conversion price is higher than the redemption value or redemption price. So if the redemption value is higher, if the redemption value is higher, the investors will not exercise that they will allow the security. They will allow this mature, then redeem. Okay, so that's what it will do. So that's that as per convertible securities. Okay, now finally, let's talk about market value of convertible. Calculating market value. Don't worry. From day one to date, we are going to practicalize every one of them. What we are doing currently is just to explain the concepts. Let's understand the concept first before we begin to do calculation. So immediately we are done, we're just going to be solving question all throughout. Okay. So calculating market value of convertible security. Okay. How do you calculate market value of convertible securities? The market value, first thing you need to know, what is market value of convertible? The market value of convertible securities represents the present value of food that is dividend, fixed dividend, and or interest, fixed dividend or interest, and the principal repayments and the principal. In this case, let's use conversion, and the conversion value discounted at the yield or rate of return of the convertible. So anytime you want to calculate market value of the convertible securities, just go ahead. Okay. So this can be calculated using the formats or using the table below. All right. Calculated. So anytime you want to compute cost of convertible security, just the same way you know, that's how you are going to calculate it. The only thing is just that you are not going to include year zero. Let me just create a small table for you. 1, 2, 3, 4, 5. Let me do a simple table. Okay. All right. The first one will be year. Here will be here. Here will be description of items. You are going to put cash flow here, like you normally do when you are calculating your NPV. Then discount factor will be here. Full. Or discount factor will be here. Then this is what you want to calculate, the present value. That's why we said that the market value of the convertible represents the present value of future cash flows. Let's say, for example, it is convertible debenture. You have a convertible debenture. So in this case, as a convertible debenture, the company is going to pay annual fixed interest. At the conversion date, the investor can decide to convert the debenture to ordinary share capital if and only if the conversion value is higher than the redemption value. Okay? In fact, let me, however, the investor will exercise the right to convert. Let me bold that. Only if it is profitable. That is, if the conversion price is higher than the redemption price. Let me bold it. Okay. Now, let's say, for example, this debenture will be converted to ordinary shares in the next 5 years. Okay. Therefore, what that simply means is that the company will be paying annual fixed interest. So my fixed interest will be here. Then at the final year, this debenture will be converted to ordinary shares. So if you can only do that if the conversion value is higher than the redemption value. So based on our hypothetical table, we're assuming that conversion value is higher than the redemption value, which means that the investors will exercise their rights of conversion. Okay. So here will be, let's say, for example, the rights will be exercised in the next 5 years. Okay, so that means the company will pay annual fixed interest for year 1 up to year 5, for example. Then in the final year, which is the year 5, this debenture or the security will be converted to ordinary shares. So put your cash flows here. Let's say you have cash flow of 10 or whatever it is. Let me just put X for simplicity. Put X there. So you go to the question, what is the coupon rate on the debt? Okay, whatever it is, you put it there, depending on whether there is tax or not. So if there is tax, you need to make an adjustment. Then the conversion value, you are the one that will also determine, in most cases, you will be the one to determine the conversion value. By the time we begin to solve questions, you will see how to do all of that. All right. Then you calculate your discount factor, whatever it is, just put it there. It's just a format. Put the conversion value there. Sorry, your discount factor. All right. Then cash flow multiplied by discount factor will give you the present value. So put your present value there as well. Then by the time you add it together, that will give you the total market value. That will give you the market value we are looking for. And that's why we said that the market value of convertible security represents the present value of future cash flows. What are the cash flows? Interest, and also interest or dividend, as well as a conversion value discounted at the yield or rate of return on the convertibles. All right. So that is that. This is how to calculate the market value of convertible securities. Okay. So that's that. Finally, let me quickly go back to what we have done before under the cost of preference share, how to estimate the market value of preference share, which is similar to this. Let me just copy this. It's similar to this, so that way it will be faster. Okay, cost of preference share. Under cost of preference share, redeemable. All right, so market value. Let me put it calculating market value of preference share. Okay, preference shares. Preference. Okay, so the market value of preference share. The market value of preference share, in case examiner is asking you to calculate market value of preference share, that's what I have to put this one again. So I don't want to leave any stone unturned. The market value of preference share represents the present value of future cash flows, that is fixed dividend. Okay, let me put it this way. The market value of irredeemable preference share represents the present value of future dividend, because the preference shareholders are only entitled to fixed dividend. The principal, they are not going to get it back. Therefore, it's only fixed dividend they are going to earn. All right then. So represent the present value of future dividend discounted at the yield or rate of return on the preference share of the preference share of the preference share. Okay, so anytime you want to calculate the the market value of preference share, simply go ahead. In this case, you are not going to use a table. The formula below, because we are talking about irredeemable preference share. The formula below can be used to estimate the market value of irredeemable preference share. Preference share. All right. So to do this, the same way you normally calculate it, the same way we calculated the cost of irredeemable preference share, this same formula is what we are going to use, except that you are going to change it a little bit, because we are talking about market value this time around. So it's not a cost. So to do this, the market value, okay, market value of redeemable preference share. Market value of irredeemable preference share will be calculated as the ratio. Okay, let me just add it. It is computed as the ratio of fixed dividend to the yield, or rate of return on the present of the preference share. Okay, so the formula below can be used to estimate the market value of the irredeemable preference share. So in this case, remember, this is the formula for calculating cost of irredeemable preference share. So what you have as the denominator, this denominator, market value of preference share, is what you now want to calculate. So all you need to do is to just cross multiply, bring it down the cost of preference share as the denominator, then using the ex-div share price as the subject. Okay. So in this case, this one will then turn to KP, or you call it rate of return, which is R. Okay. Notes. Let me move to the other side. Notes. R equal to the yield or rate of return. So that's that. This is the formula. Sorry. So this is the formula for calculating market value of redeemable preference share. This is the formula for calculating market value of redeemable preference share. Sorry, irredeemable. Yes, Evelyn, talk to me.
Sir, please, before ascertaining this formula, you said the market value of preference share, which is the MVP, is fixed dividend over X dividend share price. And it was about 100%.
I didn't say market value. I said cost. This is it now.
So what I'm asking now, how you came about the cost? No, sir, please take it back to where I'm looking at the screen to tell you what I mean. The last one you just did.
This one?
Yes. So how did you come about this KP into bracket? I can't see it very well, but the denominator per se, how did you come about that? Because that fixed dividend was in the previous formula. So the KP into bracket R.
Okay.
I know that KP is a cost
are you
of
done?
preference. Yes, sir.
Let me explain. I've already said it, but let me recap.
Sir.
I told you that market value of irredeemable preference share is calculated as the ratio. Look at it here. Is calculated as the ratio, not ration, as the ratio of fixed dividend. Okay. What is that? It's computed as the ratio of fixed dividend to the yield or rate of return of the preference share. That's the formula, and this is what you have here. Now, I went up here to mention that this is how you normally calculate cost of irredeemable preference share, isn't it, Evelyn?
Yes. Yes, sir.
And I also said that this denominator, this MVP, is the same thing as your ex-dividend share price. Okay? This MVP, market value of preference share, that's the market price per share. That's the market price per share. So it's the same thing as ex-dividend share price. So, and I told you that if you want to calculate market value, you want to determine this denominator. You want to make that denominator the subject of the formula. That's what the examiner wants you to do, which is the market value in this case. Therefore, all you need to do is to just cross multiply. So if you want to make this MVP to be the subject, right, that means this KP will become the denominator. Do you get, Evelyn?
Yes, sir.
So, and that's what I told you. That's what I mentioned here, that it is computed as the ratio of fixed dividend to the yield or rate of return. What that simply means is that you are supposed to divide your fixed dividend by the by the yield or cost of the preference share or rate of return on the preference share. And that's why we are seeing this formula like this. It's the same formula we have before for cost of calculating, formula for calculating cost of irredeemable preference share. So we just make this one the subject of the formula. That KP now become the denominator.
Okay.
Is it
Thank
clear
you,
now?
sir. Yes, sir.
All right then. So our time is fast spent. Let me just talk about cost of a redeemable preference share. Sorry, market value. The market value of redeemable preference share is calculated as the present value of future cash flows. That is fixed dividend and principal repayments discounted at the yield or rate of return on the preference share. So that's oh, preference. So this is how to calculate. You can then say, oh, why not? Preference share. The table below can be used to calculate the market value of redeemable preference share. Okay. So that's that. So here will just be our redemption, because here you want to redeem your preference share. All right, so that's it. The opposite is the same thing we have done here. We are going to do under the debt also. If you want to calculate the market value of debt, it's the same thing, except that instead, sorry, this is dividend, fixed dividend. Let me just copy so that I don't need to come back to this one next time. Sorry for taking additional minutes of your time. The class should be over by now. But let me just, so that we don't come back to this next time. Let me just, before this. So all this red color, you should know there are additional notes to the existing notes that you have. Market value of debts. Market value of debts. So the market value of irredeemable debts, I will just change one of two things. The market value of irredeemable debts represent the present value of future interests. All right, future interests discounted at the yield or rate of return of the debts. Okay, it is computed as the ratio of fixed interests to the yield or rate of return on the debts. depending on whether or not there is tax. Okay, depending on whether or not there is tax. The formula below can be used to estimate the market value of irredeemable debts. All right. So where there is tax, let me just copy once and for all. Irredeemable. Yeah. Let me copy this from here. In fact, this one I'm supposed to put it as red. Just in the next 2 minutes will be done. Pardon me. Where am I? Yes. Irredeemable. I don't need you. Get out. Okay. So number A, where there is no tax. So in this case, Evelyn, pay attention here. This is the same question you asked me the other time. So like, as you can see, previously, this is the formula we use, for the calculation of irredeemable debts where there is no tax. Now that I want to determine the value, what you have here as the denominator, this X int price is the market price of these debts. And that's what you want to use as the denominator. So in this case, I can say market value of the debts. Market value of the debts is calculated as fixed interest divided by KD, that is cost of debts. If you call it, you can call it cost of debts, or you call it rate of return on the debt, or the yield is the same thing as R. Okay. So, of course, there's nothing like percentage. It must be in Naira. Again, where there is tax. Oh, I will check later. Where there is tax, then this will change also. Market value of the debts where there is tax will be computed as fixed interest divided by the rate of return or yield on the debts. So here will be KD, all right? Or you call it rate of return, which is R. So you can see it's not difficult. Remove the percentage here. It's not difficult. That's that. Then finally, the market value of redeemable debts. Let me highlight this one. Let me bold it so that it will be different. Same thing as this guy. Okay. Preference share. Where is the preference share again? Okay. Just want to bold it to make it look different so that you can easily grasp it. Yeah. So, yes, this is where we are. So finally, the market value of redeemable debt is calculated as or represents the present value of future cash flows. What are the future cash flow here? Fixed interest and the principal repayments discounted at the yield or rate of return on the debts. Okay, so that's the market value of the redeemable debts. So we can use this table to calculate it. Here will be interest. So anytime you want to calculate the market value of redeemable debts, just go ahead, use this table. I can also use formula. All right, you are going to get the same thing, but this table is more explicit. It's more explicit. All right. So that is that. It's not more than this. All right, let me see. This is where we are going to call it a day. Wow, some of you have disappeared. Let me see those of you that are still online. Somebody send me in chats. Let me check. From Vera. Sir, please, I don't seem to understand the example and formula given for historical pattern of dividend payment in estimating growth rate. Please help me explain it at the end of the class. So sorry for taking you back. Historical pattern. Okay. This is what we are saying. Let me see if I can have this. Let me go back quickly to historical pattern. Now, Vera, this is what we are saying. You know, in calculating cost of equity, if the amount of dividend given in the question, if the dividend, if you are given a growth rate for dividend, if you are given dividend growth rates, that means this is the formula you are expected to use. This is the formula you are supposed to use to calculate your cost of equity where there is growth in dividend payment. Of course, everything must be multiplied with 100%, right? So what we are now saying is that to calculate, there are two methods of calculating the growth rates. You can either use the historical pattern of dividend payments, which is also known as averaging method, or you use the Gordon growth model. Now, your question is on historical pattern of dividend payments. And I said that the historical pattern of dividend payment is used to calculate growth rates when the history or the amount of the past information about dividend payment are given in a question. When you are given the history or past information about dividend payments are given in a question. Let's say, for example, okay, let's say, for example, you are given, okay, you are given dividend. Let me say we have, let me use a table for clarity. Let me use a table, 2, 3 years is okay. Now, so let's say, for example, this is year, right? Then we have year 1, year 2, year 3. Okay, just to be consistent with what we did last time, year 4, right? Let's say you are given dividend. Let's say dividend in year 1 is 10 naira. Dividend in year 2 is 11 naira. Year 3 is 13 naira. Year 4 is 15 naira. All right. Vera, hope you are listening.
Yes,
all right.
sir.
Aha. So as you can see, in year 1, the amount of dividend is 10 naira. In year 5, the amount of dividend is 15 naira, which means that dividend has increased from 10 naira in year 1 to 15 naira in year 4. So examiner may not tell you to calculate growth rates. So this is the information the examiner will give to you. So it is implied that you know what you are doing. So at this point, since you know that, I mean, you have identified from the question that dividend has increased from 10 naira to 15 naira within the last 4 years. So with this, in this case, you need to go ahead and calculate your growth rate. To calculate my growth rate, certainly we are going to use the historical pattern because examiner has given us past information about dividend payments. You are given the amount of dividend paid for each of the years. So in this case, this is the formula I'm going to use because you are given, I gave you 2 different formula. This is the first formula I gave last week. This is the second formula. And I said that when information about dividend payment for all the relevant years are given in the question, you are supposed to use this formula. That is, like in this, my hypothetical figures, for all the 4 years, we are given the amount of the dividend paid. Therefore, this is the formula I'm going to use. Okay, in this case, I will simply say, let me just do this example, and then that's where we are going to close. So I will say G equal to I'll put the formula there. All right. I will say N is equal to 4 years. 4 minus 1. Latest dividend is the current year, which is year 4, 15 naira. Then dividend paid, BD is dividend paid in the first year, which is 10 naira. Then all minus 1. Okay. Mathematically, I can say G equal to 4 into square root. I can say G equal to 3 into square root 1 over 1.15 divided by 10 will give us 1.5. Okay, that will give us 1.5 or minus 1. So I will use my calculator. I get the final answer. If you don't know how to use second function like I mentioned last time, then I can convert it mathematically to say G equal to, let me just copy this. All right. I can say G equal to 1.5. This is 1.5 rather. I don't even need that already. I'll just say 1.5, open a bracket. Okay, 1.5 raised to power. I don't have it here. Let me see. This is, yeah. So you simply say 1.5 raised to power. So 3 now. In this case, that will be raised to power 1 over 3. All right, raised to power 1 over 3. I don't need this again. Yeah. So all minus 1. Okay, that's it. What I have here, what I have here is what I've expressed again as this mathematically. So with this now, I can just carry my calculator. So I will just say, you are going to start from the power. You start from the power that is 1 divided by 3. That's where you are going to start from your calculator. You simply say 1 divided by 3. It will give you 0.33 whatever. You then say 1.5 raised to power answer, the answer you have in your calculator. Okay, so that will give you whatever you have. All right, then minus whatever you have in your calculator minus 1 equal, you are going to have 0.1447 whatever. So multiply everything by 100%. So in this case, our final answer, our G would then be equal to 14.47%. Okay, so that means the dividend has grown. That means dividend has grown by approximately 14% within the last 4 years. Okay, approximately 14%. Let me use approximate symbol. Approximate symbol. Where are you? Where are you? Yeah, don't waste my time. Approximate, yes. So here is 14%. Approximately. So that's that. Vera, are you still there with me?
Yes, sir, I'm here.
So you understand what we just did now?
Yes,
That's
sir.
what is so that's what is expected of you. All right.
Thank
So
you,
that's
sir.
it. You're welcome. So yes, some of you have disappeared. It's okay, it's expected. But I still have majority of you around me. I can see Tony. Tony is still here with me. Augusta is keeping me company. Biola is here. Chioma, Vera, Evelyn. I can see Ezine. The Galaxy 16 did not start with us. Ahmed Akinwale, Ansin, Ijem, Amaka, Kingsley is on. I can see Ghost and Mary Joby is still on. Joy is on. Judith. I can see Matthew. I can see Moses. Festus. Nancy, how are you? You didn't start with us, Nancy. Then I can see Oluwafemi. I can see Tayo. Tayo, you too, you did not start with us earlier today. Then I can see Amarachi. Fumilayo Popola is still on. Ruth is on. Sandra is on. Shola is on. Daniel Uko is on. Valtor is also on. Victoria is on. Oluwatoyin, then Zoom user. I want to say thank you to every one of you for keeping me company. Thank you. I appreciate. By the grace of God, we are going to continue in our next class. And in our next class, we are going to start our discussion from how to calculate weighted average cost of capital. All right. Then from that, once we are done with the explanation within few minutes, all what we are going to be doing going forward will just be calculations. All right. So I need you to go ahead, please. Go and read all the notes you have been given from lecture day 1 to lecture day 2, the one we had last week and today. Ensure you go through them. Master the concepts, master all our discussions, so that by the time we begin calculation, you are not going to struggle to understand how we are getting the numbers. All right. Thank you, everyone, once again. I will see you next time by the grace of God. Bye-bye. Good night.
Thank you, sir. Good
sir.
night.
Yeah.
God
Good
bless
night,
you,
Nice,
sir.
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 Thank you, sir.
Night. Yeah.
Nice, sir. Thank you, sir.
Good night, sir. Good night.
You're welcome. Okay. Alhamdulillah.